All right, pause whatever you're doing for a second and hear me out. Because something genuinely rare is happening in the silver market right now, and it's not the kind of move you see once a decade. In the last couple of hours, Western silver markets blew past $121 an ounce, while China's futures market printed $146.17. Let that sink in. That's not a typo. That's a 26.50 premium, live, right now. If you've ever wondered what a market fracture looks like in real time, this is it. And stay with me here, because this isn't just about price. I'm going to show you why this kind of split only happens when something underneath the system is under real stress, and more importantly, how you can spot these signals before they hit headlines. If you're watching this right now, you're ahead of most people who'll only hear about this on mainstream news 3 days from now, when it's already priced in. Before I explain what caused this massive split, let me teach you something most people never really learn about commodities. There isn't just one silver price. There's the paper price, the futures price, the spot price, and then there's the physical price where actual metal, real bars, change hands between buyers and sellers. Most of the time, those prices stay close enough that nobody questions it. Think of it like airline tickets. The online price looks cheap, everything seems fine, until everyone shows up at the gate at once, and suddenly, there are no seats left. The screen price didn't change fast enough to reflect what's actually available. That's exactly what you're seeing here in silver. When physical demand overwhelms supply, when people want the actual metal and not just a contract promising delivery later, that paper quote becomes more of a suggestion than a truth. It's a lag, a disconnect. And that disconnect is telling you something critical about what's happening beneath the surface. So what does that tell us? It tells us that price discovery, the actual process of figuring out what something's worth, is breaking down between two of the world's largest markets. Now here's what's actually happening, and I'm going to break down the sequence for you because the order matters. This isn't random chaos. First, global silver supply has been running in a persistent deficit for years. Not months, years. Mines aren't producing enough to meet demand, recycling hasn't filled the gap, and industrial demand keeps climbing, especially from solar panel manufacturing, electrification projects, and advanced electronics. Every solar panel uses silver. Every electric vehicle uses more silver than a gas car. That demand isn't going away. Second, physical inventories have been quietly draining. Vault stocks at major exchanges are down hard. Refiners like the Perth Mint and Metalor have paused new orders, and that's a huge tell. When refiners stop taking orders, it's not a marketing decision, it's scarcity. They literally don't have enough metal to commit to future deliveries. Third, China stepped in aggressively. Shanghai spot prices surged toward $139, and futures went even higher to that $146 level I mentioned. That's confirmation. When the world's largest industrial metals consumer is willing to pay a massive premium over Western markets, that's not speculation, that's urgency. That's China saying we need this metal now, and we'll pay whatever it takes to secure it. Here's what's wild about this, and this is where it gets interesting. Western markets are still largely pricing silver through paper contracts, derivatives, futures that don't require immediate delivery. Meanwhile, China is increasingly pricing based on physical availability. They want the bars. They want delivery. So when physical metal gets tight, when inventories drop, and refiners can't fulfill orders, the Chinese market responds instantly. And the paper market? It lags. It takes time to adjust. That's how you get a $26 premium. That's how you get this fracture we're watching right now. But here's the part that should make you nervous if you're not paying attention. When premiums explode like this, when the gap between paper and physical blows out to these levels, it often forces the paper market to catch up violently. Not smoothly, not gradually, violently. Because at some point, delivery matters. Contracts come due. Someone has to produce actual metal. Inventories get tested. Vaults get checked. And suddenly, price discovery snaps into place instead of drifting along. The paper price has to acknowledge what the physical market has been screaming for weeks or months. And that adjustment? It's rarely gentle. Now let me show you what very few people are talking about. This premium isn't happening in isolation. Look at lease rates for silver. They've spiked. That means the cost to borrow silver for short-term delivery has gone up dramatically. Look at the futures curve. It's showing signs of backwardation in some contracts, which means near-term prices are higher than future prices. That's backwards from how it normally works. Normally, you pay more for delivery further out because of storage and carrying costs. But when backwardation shows up, it means people are desperate for metal now, not later. They'll pay more to get it today than to wait 6 months. That's stress. That's tightness. That's the market telling you something's not right with supply. Zoom out for a second, because this isn't random. This is the same playbook we've seen before in other commodities. In the late 1970s, silver didn't just rise, it disconnected from normal trading patterns. First through shortages, then through backwardation, then through panic repricing that took it from under $10 to over $50 in less than 2 years. In 2011, premiums blew out before price followed. Silver went from the teens to nearly $50 again. Even in smaller commodity squeezes, copper in 2021, nickel earlier in 2022, palladium in 2020, the pattern is consistent. When physical markets lead and paper lags, when the people who need the actual metal start bidding aggressively and the futures market hasn't caught up yet, the resolution is rarely gentle. Every time sustained physical deficits meet rising global demand, the market eventually reprices to reality. And here's what matters. We're now well past the early warning phase. The whispers have been happening for months. Vault drawdowns, refiner delays, tightening lease rates. This price move? This is the market starting to shout. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this cool off? Of course it could. Margin requirements could rise, making it more expensive to hold leveraged positions. Authorities could intervene with new trading rules. Liquidity events, some unrelated shock to financial markets, can cause sharp pullbacks even in strong trends as people rush to raise cash. And yes, silver markets have a long history of volatility and manipulation claims. People love conspiracy theories in precious metals. Here's the thing though, you don't need a conspiracy to explain this move. You just need math, supply, demand, inventory. Those are facts. Focus on what you can control. Watch spreads between markets. Watch delivery volumes at exchanges. Watch premiums at dealers. Those don't lie nearly as often as narratives do. Could I be wrong about where this goes? Absolutely. But the mechanics I'm showing you, those are real regardless of what happens next week or next month. There are probably 3 types of people watching this right now, and I want to talk to each of you directly. Some of you already own silver, and you're wondering if this is the blow-off top. You're worried you held through years of sideways grinding, and now that it's finally moving, you might give it all back. That's a fair fear. For you, the key isn't guessing the exact top. Nobody rings a bell. The key is managing risk and understanding why you own it in the first place. If you bought for long-term supply deficit reasons, those fundamentals haven't changed. If you bought as insurance, insurance doesn't have a price target. If you're up significantly and want to take some profits to lock in gains, that's not wrong either. Just make sure you're deciding based on your plan, not based on fear or greed in the moment. Some of you are on the sidelines thinking you missed it. I get it. You watched it at $80, then $90, then $100, and now it's over $120, and you're thinking it's too late. Let me be honest with you. Chasing vertical moves is dangerous. Buying something just because it's going up, without understanding why, that's how people get hurt. But ignoring structural signals is worse. If the fundamentals are real, if this is truly a supply-demand rebalancing and not just a speculative blip, then pullbacks in structural bull markets are normal. They're healthy. They shake out the weak hands. If you're interested in silver, use pullbacks to build a position. Don't chase. Wait for consolidation. And make sure you're sizing appropriately for your situation. The third group is just trying to learn. You're not sure if you should own silver or not, but you're watching this unfold and you want to understand what's happening. For you, this is the lesson. Markets whisper before they scream. Premiums, inventories, delivery stress, backwardation, lease rates, refiner delays, those are the whispers. Price is the scream. By the time price is moving this violently, the smart money has already positioned. Your job, if you want to get better at this, is to learn to hear the whispers. Track inventory data, watch spreads, read refiner announcements, follow supply-demand reports from industry groups. That's how you get ahead of moves instead of chasing them. So here's where I stand, and I'm going to be straight with you. I'm not blindly bullish and I'm not dismissive either. I'm watching three things very closely. First, I'm watching whether China's premium holds or expands. If that $26 gap stays wide or gets wider, that tells me physical demand isn't letting up. If it closes quickly, maybe this was just a short-term squeeze. Second, I'm watching whether Western vault inventories continue to drain despite higher prices. Normally, higher prices bring out supply. People sell, scrap increases, mines ramp up. If inventories keep falling even at $120, that's a problem. That means demand is still overwhelming supply even at these levels. Third, I'm monitoring whether futures curves stay tight or move deeper into backwardation. If backwardation spreads across more contracts, that's escalation. That's the market saying this isn't getting better, it's getting worse. Based on my analysis, this move wasn't emotional. It wasn't driven by retail traders on social media or some pump scheme. It was mechanical. It was structural. You had supply deficits, you had inventory drawdowns, you had China bidding aggressively, and you had paper markets that hadn't adjusted yet. Those forces collided, and this is the result. The fundamental picture hasn't broken down. If anything, it's validating. The supply deficit is real, the inventory decline is real, the industrial demand is real, and the market is starting to price that reality in. If history rhymes, and I think it does more often than people realize, silver isn't just repricing right now. It's redefining what cheap even means. For years, people looked at silver in the 20s and called it expensive because they remembered when it was $15. Then it went to $30 and people said it was a bubble. But if the structural deficit is real, if we're genuinely running out of easily available silver while demand keeps rising, then maybe $50 isn't expensive. Maybe $80 isn't expensive. I'm not making a prediction. I'm not telling you it's going to $200. I'm telling you that your framework for what's expensive might need to change if the fundamentals are what they appear to be. Now, I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Don't take my word for it or anyone else's word. Make your own decisions based on your own situation, your own risk tolerance, your own goals. If you made it this far, you're the kind of person who wants to understand what's really happening instead of just reacting to headlines. That mentality will serve you well, not just in silver, not just in commodities, but in every market you ever trade or invest in. Understanding the mechanics, recognizing the patterns, hearing the whispers before the screams, that's how you get an edge. So here's what I want you to do. Drop a comment and tell me what you're watching in silver or precious metals right now. Are you holding? Are you waiting? What signals matter to you? And if this breakdown helped you understand what's happening, hit that subscribe button, because this is exactly the kind of real-time market analysis I bring to this channel. No hype, no agenda, just patterns, data, and honest analysis. Stay sharp out there, verify everything, think critically, and make sure you understand the game you're playing before the next move hits. I'll see you in the next one.